think that in Q1, I think there are pretty good odds we're going to see silver back at $35. And I think anything from sort of Q2 onward, we could potentially realistically see something around 40 or north of 40. And I do think we'll have quite likely touched 40 at some point next year.
Peter Krauth, a seasoned precious metals analyst and author of The Great Silver Bull, holds a bullish outlook on silver for 2025 and beyond for several reasons. First is the metal's worsening supply deficits and increasing industrial demand. The silver market has experienced consecutive annual deficits, with demand surpassing supply by approximately 200 million ounces annually. Likewise, silver's industrial applications are expanding, particularly in electronics, solar panels, and electric vehicles. In 2024, industrial demand is expected to account for 70% of total silver supply, up from 50% in previous years. Solar panel manufacturing alone represents over 20% of global silver consumption. According to the Silver Institute's estimates in the 2024 World Silver Survey, the global silver deficit will rise by 17% to 215.3 million troy ounces in 2024 due to an expected 2% growth in demand, again led by robust industrial consumption, combined with a 1% decline in total supply. Additionally, Krauth believes that ongoing government spending and escalating debt levels will support higher silver prices. In 2025, central banks are expected to embark on widespread policy changes, swiftly moving from the quantitative tightening measures of the past 2 years to full-on money printing and other quantitative easing measures. Krauth is certain that silver prices will benefit greatly from these exercises. He estimates that the metal's price could reach $35 in the first quarter of 2025, and potentially $40 later in the year, as the above-ground silver supplies are completely depleted and investors, including central banks and industries, scramble for the small supply available. In a recent interview with The Deep Dive, Krauth compares these interesting dynamics of the silver market to those of the uranium market, which has seen considerable price recovery in recent months, specifically as a result of rising demand and supply constraints. Krauth says these issues are equally applicable to the silver market, which is why he expects silver prices to soar significantly in coming years. We will now present clips from Krauth's interview. Before diving in, please remember to support our channel by liking this video, subscribing, and turning on notifications to stay updated on content related to precious metals and economic analysis. Thank you, and enjoy the video.
You know, I had said that I expected $35 in Q4. We reached that earlier this quarter. I'm not surprised. It was quite the run-up. If you look at, I think back in February, we were at $22. So that's, I think, something like a 45% gain. It's really pretty tremendous within this calendar year. So I'm not surprised to see it pull back a little bit. I do think that somewhere around the 28, 29, 30-ish is a floor. I have also said that I think that, once we make it meaningfully above 30, that 30 would become a new floor. So far, it's looking like that's kind of how it's playing out. So I think that, the odds are a lot more favorable for the upside than for the downside at this point in silver. And, I was talking about a little bit earlier about, doing research, understanding the market, and so on. And I think one really, really good example might be for people to look at what has happened in the uranium market, because that's been pretty fantastic actually for over the last few years. It's become quiet, but at a much, much, much higher level. And if you are interested and you pay attention and you look at what's going on, uranium has legs for the next, I'm going to say, decade and beyond. And it's comparable in a lot of ways. So I like to quote a really, really interesting thing from a really very smart guy, a highly experienced, really seasoned guy by the name Leigh Goehring. He's with Goehring and Rosenzweig out of New York City. And Leigh Goehring actually managed one of the world's largest commodities funds several years back. And so this guy knows what he's talking about. And So here's what he said. He said 5 years ago, we became uranium bulls because the market had quietly slipped into a structural deficit and reactor demand had been outstripping mine supply. So what happened was fuel buyers used what we call so-called secondary inventories to fill the gap. So they didn't have to pressure miners to produce more uranium. They were able to tap into these secondary supplies, these above ground stockpiles of uranium, and drain those inventories. So Gehring saw this and he said, well, guess what? All these uranium miners have scaled back because prices had been so low for so long, about a decade, and production was, very minimal at that point, and there was no pressure on the uranium price because the consumers of uranium were able to go and as I say, drain these above ground secondary supplies. But what happened after that? So about 3 years ago, uranium was still at about $25, $27. Today, we're at around 77. We've been above 80, and we've been meaningfully around 80 for months, if not a year at this point. So I'd like to draw some really, really interesting parallels with silver, because if you understand what I just explained about uranium and where uranium went and what happened with a lot of uranium stocks because of this triple in the uranium price, you haven't missed a boat, because you can look at silver right now and you have essentially the same setup. So over the last 4 years, just quickly, the silver market is about 1 billion ounces a year of supply. About 85% of that comes from mining and about 15% comes from recycling. However, demand for this year and over the last 4 years has been well beyond supply. This year to the tune of 20%. So we're consuming 1.2 billion ounces, and yet we're only producing 1 billion ounces. So, people have asked, and I've asked myself, well, in this kind of environment, how come silver is not $50 or $60 or something, much higher? And you really have the exact same thing as what happened in uranium. You have secondary supplies, so above ground stockpiles of silver. These are the identifiable stockpiles are actually sitting at the COMEX, the LBMA, the Shanghai Futures Exchanges, and in some silver ETFs. Beyond that, you do have difficult to quantify private hoards of silver. So if we put that aside for now, we do know at least we can look at and see what's happening with these measurable secondary supplies in these futures exchanges. And since early 2021, these exchanges have seen their supplies drop from anywhere around 40% to 70% in the last 3 to 3.5 years. It's kind of gone a little bit sideways over the last 4 or 5 months. But for 3 years, from early 21 till early 24, they've been dropping very, very, very steadily. So here's the parallel. The big consumers, I believe, the big consumers of silver, in industry, electronics, solar panels is the biggest one now, have been able to tap into these above ground silver supplies and buy silver, buy it at spot price, not put pressure on producing more silver to meet this excess demand over supply, and feed their need. And this supply is only going to last so long. When that runs out completely, then we're going to see silver just absolutely explode, and I think potentially do something like uranium did, which was to triple in a matter of a couple of years, because there is very, very difficult headwinds in terms of trying to get more silver out of the ground. Ore grades are falling. Only about 25% of silver comes from primary silver mining. The rest of the mined silver actually comes from as a byproduct of mining gold, copper, lead, and zinc. And that's what we're facing. So if you look at that and you understand the setup, you realize that, and by the way, there was an interesting research by S&P Global Intelligence that looked at silver from primary silver mines, and they think that will actually peak within 2 years. So uh, true silver mines will actually start seeing output globally fall within 2 years. So the the picture for silver supply is not rosy, but demand is super strong, likely to continue that way. And there's one thing, as we know in economics, lack of supply, strong demand means that the commodities price has to go up.
Krauth emphasizes that the persistent annual deficits in the silver market have been mitigated by drawing down existing above-ground stockpiles. He warns that these reserves are depleting rapidly and could be exhausted within the next 12 to 18 months. Once these stockpiles are depleted, the market may face significant supply constraints, potentially leading to substantial price increases. Krauth recently shared this image on social media, showing the silver inventories of the London Bullion Market Association, COMEX, and the Shanghai Futures Exchange. According to the renowned silver bull, this is how the silver deficit is being met. However, the chart shows that these inventories are quickly being depleted, meaning silver could soon have its own uranium moment. Krauth's analysis aligns perfectly with a recent report from Canada's TD Bank. The report warns of an imminent silver squeeze, which the analysts predict will lead to a near-total depletion of above-ground silver inventories within 12 to 24 months. Silver markets may be set up as the most exciting trade in the energy transition theme across the entire commodities complex today, the researchers noted in their report. Let's get back to Krauth's video.
So there are a couple of things to consider. One is the first thing I want to say is this: the Silver Institute thinks that, and they're pretty conservative. I feel that they're not sort of aggressive or even frankly realistic enough sometimes. But that being said, they forecast that we're going to have about a 215 million ounce deficit this year. If you add up this year and the last 3 years, so these past 4 years, that's somewhere around 800 million ounces of silver. That's 80% of 1 year's supply of silver we've seen in cumulative deficits over the last 4 years. The Silver Institute also believes that we are going to see deficits for years going forward. They don't see that changing. And they think we're going to actually hit new record deficits within the next 5 years. So that picture, that side of the equation hasn't changed. And it's looking like supply is also not changing. It's staying flat, if not dropping. We know how challenging it is to find deposits, economic deposits, bring them to production. It takes a long time to get them permitted, financed, and all the rest of it. And silver is very particular because, as I say, primary silver mines are rare. You want high-grade ones. Ore grades are falling. So it's very challenging. Like I say, there's one reasonable response to expect, and that is higher silver prices. I point to my example at the beginning. Uranium is a really, really good analog for this. The uranium price essentially tripled, and something similar in silver would just not surprise me at all.
And so obviously a lot of people who are watching this are retail investors and they're trying to figure out, I like silver. What's my best way to get exposure? What do you tell these people?
Do some reading, do some homework. Don't buy these meme coins. you know, buy buy a real asset and buy, even if it's an explorer. Geez, at least someone who has a potential of getting you some of your money back and maybe a little bit of a gain. Um, and they can be pretty exciting too, because they're pretty volatile sometimes, especially when the silver price starts to move. I mean, I've got a couple of companies in the portfolio that this year we took, we took profits on 100% gain. So they doubled. In one case, it took about a year and a half. In the other case, it took about 2.5 years. But that's not bad in that time frame. Thankfully, in fact, we took those profits because those share prices actually dialed back. So, anybody who bought them when they were originally recommended are actually hold them now at no risk because they've gotten their money out fully by having sold on a double. But there are a lot of really interesting, I'm going to say, especially if you want something a little bit, with a little more juice, You don't have to, but it depends on your risk profile, your comfort level. But there are plenty of juniors out there that are very high quality, have historic mines or are historic plays where there has been in the last few decades very high grade silver production. These companies have raised money. They're starting to drill and to see sizable discoveries. I think is going to also, light a bit of a fire under the market. So do your homework, look into this space, maybe subscribe to a newsletter or two and get a feel for what's out there. But, I also do want to say that, and in my book, I talk about this, if depending on your risk profile, you don't have to take outsized risk either. And you could do really well if you're patient. If I have this right, just roughly, Pan American Silver from, I believe it was around 2003 till 2008, did something like a 15 or 16 times return. That's 15 or 1600% return in the world's largest publicly traded silver company. And then you have Wheaton Precious Metals, which is the world's largest royalty company, which has about 45 or so percent of their revenues from silver, which is quite impressive. They were up 17 times between 2008 and 2011. So these are the two of the largest market cap companies in the silver space, and you could make 15 times your money in a matter of a few years. So you don't have to take huge risks. If you are, I suggest you spread it across a few companies of different sizes. And if you are going to go into juniors, look at maybe as many as 5 or so, spread it across a few names, because some could go to zero, and while some could be 10 baggers, it's impossible to really know which will be which. So the 10 baggers will more than pay for, your 1 or 2 that maybe went to zero.
In their report published earlier this year, TD Bank analysts pointed out that the recent surge in silver demand and the global underinvestment in the mining industry have led to a universally recognized structural deficit. The analysts concluded the report with a cautionary note. For many years, market participants could safely assume that the behemoth stockpile of above-ground silver would be sufficiently large to satisfy any reasonable scale of demand growth. Today, we believe this assumption could potentially be challenged within the next 12 to 24 months. Krauth has similar analyses and predicts an impending mania phase for silver, causing prices to rise as high as $300 per troy ounce. Do you agree with his analysis and predictions for silver? Please share your thoughts on Peter Krauth's insightful analysis in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.